Everyone, this is Robert Keens with goldsilverpros.com, and I'm joined by a very special guest today, John Williams of Shadowstats.com, to talk about government statistics and what he is seeing in the economy. John has a long background of measuring the economy of over 40 years and provides great insight into what's going on in inflation, unemployment, and many more numbers. Stay tuned for the interview. But how long has your service been out there?
It is, I started this, Shadowstats I started in 2004, but I've been an active economist for over 40 years.
Oh, wow. 40 years. So in terms of all of your research into, I guess you're using 80 statistical models for things like inflation. How long have you been publishing that data?
Well, let me put it this way. I went to Dartmouth and the Tuck Business School, where I studied economics and business forecasting. Family business imported chainsaws from West Germany. I built an econometric model on the chainsaw industry and one on the silver market, which was of interest at the time. Got to know a fair number of people in those industries. The chainsaw industry was the one I was going into. Imported a chainsaw from West Germany, and the first day on the job, Nixon floated the dollar. So all of a sudden I became a currency trader, and it was an interesting time. No one had been really quite through what we were going through at that point in time, and I learned that in the case of Nixon, he was in the process of or facing impeachment hearings. And with that, whenever something went somewhat awry in the hearings or negative for the president, you'd see that the dollar would respond negatively about 15 minutes later. So it gave us time to take positions, and for a little bit of time there, that actually worked very well. And the dollar, unfortunately, continued to collapse, and eventually it just priced us out of the market in the United States. We worked in arrangement with the German manufacturer, and they were looking to build a plant over here, and they did that, and eliminating us gave them an extra level of profit margin, and they went their way, and I went mine. And I started my own economic consulting firm. I hired a brilliant guy, mathematician, modeler, to help me with it. I had background in that area, but the problem with economic forecasting at the time and economic models was that you had these grand scale economy models for the U.S. activity, 30,000 variables and all sorts of equations. The only problem was that if you wanted to forecast where interest rates are going to be next year, you first had to know where inflation was, or where it was going to be. So if you knew where inflation was next year, you could plug that into the model, and that would give you an estimate as to where interest rates would be. But if you knew where inflation was going to be next year, you didn't need the models to tell you where interest rates were going. So I specialized in developing econometric models that were based on existing numbers that had a leading relationship, so that you could forecast key economic indicators like retail sales or long-term and short-term interest rates up to about 9 months in advance based on actual data. And you could do so with some accuracy, and that worked well. And that's where I really started building my economic business. But as we got along, and keep in mind that Nixon had removed the dollar backing for gold, we just went off the gold standard. That was back in '71. In the early '80s, we were beginning to see domestic inflation that was picking up from the dollar no longer having the backing of gold. If you looked at the price of gold against domestic inflation, it matched reasonably closely over time. And I'm looking at inflation going back to the 1600s in New Amsterdam, which is now New York City. But the federal government in the early '80s decided to redefine the way they calculated inflation, or at least they started to reduce the headline inflation, because if they could somehow reduce the headline inflation, that would mean they had to pay out less in Social Security benefits or government pensions, and that would help them some in terms of reducing the budget deficit, but it was really a fraud because they were redefining inflation away from what the average guy was used to, the way he viewed it, and that being his out-of-pocket expenses tied to inflation and prices rising. First thing they did, first big move was in the early 80s. They redefined the cost of housing in the CPI, the Consumer Price Index, which is the number that everyone follows and which most of the cost of living adjustments are based off of. What they did, and you have to keep in mind that in the complex formulation there for the cost of housing, one of the components was the cost of buying a new house. They changed that to and redefined it as the homeowner's equivalent rent, what a homeowner would charge himself to rent himself his own house. And then the month-to-month inflation rate there was the amount that the homeowner would increase the rent to himself each month to rent his own house. Absolute phony number, completely gimmicked by the government. The fact was that it knocked 1.4 percentage points off the headline CPI, and that aggregate going forward. And they changed a number of other factors. So they got into in the 90s. They looked at substitution effect, and the way consumer prices had been defined, and the way the cost of living was defined, was the cost of maintaining a constant standard of living. That's very important. You want to maintain your constant standard of living, and that's sort of your baseline. If you can make more and improve your income versus a constant standard of living, you're doing worse. You don't want to fall, because that means that your quality of life is declining. Well, in an effort by the Fed and the federal government, and you had Newt Gingrich heading the House of Representatives, you had Alan Greenspan as head of the Fed, and this was during the Bush administration. Well, what Alan Greenspan argued was, well, really, if people are buying steak and steak gets more expensive, they'll tend to buy chicken. If they buy chicken, that actually lowers their cost of living. So we really should put in substitution, and so that allow for substitution for chicken for steak when steak gets too expensive. Well, what he said was true, except that was completely contrary to the definition of maintaining a constant standard of living and what the CPI was supposed to represent. Shortening this all up, I took strong objection to that. It was clearly designed to hurt people who were on fixed incomes, and they were having the government's budget deficit bailed out on their backs to a certain extent, because the whole concept of what they had behind cost of living adjustments and such was maintaining a constant standard of living. The government changed that, and it did help them some, but they always continued to increase their deficit. But they were also very good about publishing the changes that they made. And what I did was I just reversed the changes and continued to track the CPI on a regular basis as though they hadn't made the changes. That made a big difference over time, because what you'll see is that if you look at the headline CPI today against gold, and you chart it back to the 1600s, going back just the two series together, they stay pretty much consistent with each other up to the point where Nixon abandons gold. Then you have the price of gold beginning to pick up against the headline inflation, and this is as they start to redefine the series in the early 80s, the gold almost goes up exponentially against what happens to the headline CPI. But if you look at my estimate of what the CPI really was based on what they had removed from the CPI, that CPI kept right up with gold. In fact, my contention is that gold kept up with the real cost of living, that the gold is effectively real money. It measures, it reflects It reflects maintaining a constant standard of living if you hold it. If you take your dollars today and put them into gold, over time, the dollars that are put into gold the price of gold will rise, and you will maintain the cost of living that you put into those that you put into gold. Right now, it's the differences between the two are extraordinary in terms of year-to-year change. I think it's about 7 percentage points between what my inflation is showing, year-to-year change, on top of the government's headline number, which until you had the oil price collapse a month or two ago, it was running a little around 2%, 2% plus or minus. So that real inflation is up around 9%, assuming that we get back to that 2% base as the oil price stabilizes.
That's a stunning revelation, John, because 7% year over year makes a big difference when you're compounding inflation. For example, going back to what you said earlier, you're calculating benefits for people living on government assistance, or we're calculating investment returns. And anytime you have, more than a few percent and it's compounding every year, it makes a really big difference over time. So given how long this has been going on, back to the 80s when this was first done, how long can this go on before people begin to see that reality is different from what the government is reporting? Or do you think people are already at that point?
Well, I think most people are aware that they understate inflation, and it's gotten to the point that we're now beginning to see an acceleration in the price of gold, and that's anticipating. The price of gold tends to lead inflation a little bit. It's not set day to day, but the general trend here is followed very closely over the decades. And what we're seeing right now is a pickup in both gold and silver prices against a circumstance where the Fed has opted to create unlimited money supply, and the federal government is spending extraordinary amounts of money without any regard to the budget deficit or what's sustainable debt levels in the United States. They're in an emergency. They're trying to prevent a systemic collapse, which we've seen elements of already. And I think they're just looking to try and forestall a full systemic collapse financially, or at least to push it off as far as they can into the future, rather than take it in hand today. Very dangerous times. I would look to put my assets into physical gold and silver and ride out the storm. I mean, there are going to be ups and downs. There may be massive interventions here, but I don't see any way that you're going to be able to avoid much higher inflation and accordingly much higher gold and silver prices that will tend to, again, maintain the purchasing value of the assets that you have today.
So you think that, sorry, John, to interrupt you. You think that there are going to be more interventions in the market? You think that the Fed is basically pot committed at this point, that they have to continue just printing money until the end of the system, and that do they know the end of the system is coming? I mean, are they smart enough to figure that out, and they're just not telling people?
Look, you're dealing with very smart people here. They know exactly what they're doing. They just don't have a solution. And there's a tip-off there. Extraordinary circumstance. I mean, you shut down the economy, the stock market collapsed, and that's now being propped all sorts of ways and all sorts of gimmicks, and Wall Street's doing everything it can to keep the stock market going, but you're not going to have corporate earnings to support it. I mean, the Fed may intervene, but it's not a real circumstance. It's not a sustainable circumstance. When the Fed took their first immediate action, what did they do? They eliminated, among other things, and pumping extraordinary amounts of money into the system, reserve requirements for the banks. First time that's ever happened. Now the reserve requirements for the banks, these are businesses that operate lending money to people, and they want to stay solvent. You don't want to have a run on the banks or anything like that. So that the banks were required to hold reserves against the loans that they made. People would deposit their money. The banks would lend a certain portion of that out as new loans. And if somebody defaulted on a loan, the bank had to be able to cover that without going insolvent. So they would hold cash in reserve or cash equivalents in reserve to cover some bad times. The reserves were put at zero. Never seen that before. Now, if you go back for the last, forgetting Mr. Powell, who's in the current circumstance, once you look at Janet Yellen, Ben Bernanke, Alan Greenspan, each of them got to address the money supply in terms of its relationship to inflation, and each one had a statement that says effectively we can create any inflation we want by printing money. And you didn't have Mr. Powell, Fed Chairman Powell, say we're going to create inflation, but he has indicated they will create unlimited money as needed.
Do you think the unlimited money is to bail people out of their debt positions? Because one thing that I've been writing about, and I've talked with several people about, and I kind of predicted the repo crisis 6 or 7 months before it happened, although I didn't call it the repo crisis. I looked at the amount of outstanding dollar-denominated debt in the world, both domestically and foreign, and then I looked at the amount of dollars that had been physically created according to, I believe it was the St. Louis Fed, and one was a fraction of the other. And what I predicted would happen was there was actually going to be a dollar shortage in terms of the finance markets, not necessarily in terms of Main Street America, but in terms of, you know, what happens in the finance sector. And then we had the repo crisis, I guess, last September, where the Fed had to inject liquidity into that for the overnight lending market. Is a lot of what I'm wondering, if the Fed is creating a lot more money, will we see inflation right away because our business is going to use it to extinguish debt or potential bad debt? Or do you think that regardless, it's going to hit, you know, Main Street, it's going to hit consumers, and you're going to see prices start to rise?
Well, consumers are going to see prices start to rise. In fact, they already have. You have a combination of factors there. I can't give you the precise timing here because there are all sorts of things that they may do, and but there's nothing much they can do to avoid the ongoing debasement of the U.S. dollar, which basically means inflation. I mean, to start with, they're not fully reporting the inflation rate, but you've had an economic collapse that was not created by normal economic circumstances. It was created by a pandemic, and the government just shut down the economy, shut down the system, shut down the social system. And what's just beginning to work out is that we're having some shortages. Industrial production is way down now, and as was retail sales initially, and then headline reporting has that coming back. And I've got some serious problems with the quality of the numbers that are being reported right now, because you're still in the midst of the pandemic and the pandemic shutdown, and the government surveying just is not working the way it used to. But effectively, with a supposed rebound in retail sales, but with the industrial production not rebounding. And the last reporting in May was actually below where it had been in April. It was revised, although the May increased a little bit. That was on top of a downwardly revised April. So if you have the consumption picking up but not the production, you get a shortage in product. Now you've seen there's some early examples of that with beef back in May, and we'll be seeing a lot more in the next week's economic releases as to what's happening here. But you had because of a shortage in beef prices were up 48% in the month of May, and you had a record monthly increase. I think it was 1.3% or such for the month of May for the producer price index. Now that's a series that was recreated back in 2009, so that's only a 10-year history, but you're beginning to see similar pressures there in the CPI. And as products have been sold, inventories have been worked down, and it's not being replaced by production, you're going to see increased shortages with too much money in the system going after that. That tends to boost prices. I think you're going to see ongoing upside price pressures here on out, and it's going to start to accelerate. I think that's why you're beginning to see some slowly increasing trends in both the gold and silver prices. That accelerates, again, the gold will tend to lead the inflation. It's because people are seeing the inflation. They know it's coming. They're shifting to get well positioned for it.
Do you think that the big money managers are starting to go into gold? Because Main Street doesn't seem to be too aware of this. I think maybe they're starting to get the picture, but the rising gold price to me, and we see really large inflows into things like the GLD and the SLV, for example. So, but I'm guessing, or at least looking at the data, it looks like it's big fund managers.
It could be. I have no specific knowledge there.
Okay. Wanted to switch gears to
about it. I have a number of people who read my stuff, but
yeah,
I don't have anyone that's really talking to me saying, "Yeah, here's what we're doing."
Okay.
I just give people information, and they use it. They use it the way they want, or use it to assess what they're already looking at. Does this reinforce what I'm looking at? Does it counter what I'm looking at? I have all types that look at my material and use it as they will.
Yeah. Well, they're smart for doing that because I think they're ahead of the curve, definitely. I wanted to look at unemployment for a moment. When I went back and researched unemployment, I actually put this in my book, and I looked at your data, and then I did my own study as well for my book that I wrote in 2009. It's called Drop Shadow: The Truth About the Economy. And that's actually where I started writing and publishing about 10 years ago. They used to report full unemployment and what I would call like unfettered unemployment. They would report, it was more like the labor force participation rate. They would report everybody who wanted a job who couldn't get a job. And I believe also there was some information available on not ideally employed, such as you're working part-time versus full-time. And I don't think that they're really doing that anymore. And the number that they're quoting, the U3, seems to be extremely misleading because it seems to leave out the people, sort of this, what I call structural unemployment, people that have not been able to find a job for a long time. Is that your understanding of how they report the unemployment numbers?
Yeah, well, let me clarify. I published an alternate measure, and it's what happened. Again, with my alternate CPI, I went this way because before this, I had models that could give you a pretty good idea as to where things were going to be going based on what was already happening with the underlying numbers. But as soon as they started monkeying around with the definitions, all of a sudden what you're forecasting wasn't quite what it used to be. And where they hit the inflation back in the early 80s and into the mid 90s. After that, it's really they haven't changed it much in the last decade or so. But in 1994, they changed the calculation on the unemployment rate, and indeed, the headline unemployment rate was in theory not redefined, although they did change some of the fine surveying points that could affect it some. but the headline unemployment simply is the number of people who are actively looking for work and active in that they've actually looked for work in the last month and are unemployed. They consider themselves unemployed. As long as you're actively working, you're counted as unemployed, and the unemployment rate is the number of people who are employed plus that count of unemployed. That's the labor force, and it's a percentage of the people who are unemployed versus the labor force. It's the unemployment rate. So that was that's the way it was defined before. That's the way it was defined after, but again with some gimmicks in the way they actually did some surveying. But before 1994 is when NAFTA came along, and that's why you saw the change here, because the effects of NAFTA they were clearly going to unemploy a number of people and displace their jobs and ship them offshore. That was what was intended, and it was where they had broader measures there. They have had what they called a discouraged worker. They counted discouraged workers. A discouraged worker was one who was not actively looking for a job, which you have to be doing in order to be in the headline unemployed, but had given up looking for work because there were no jobs to be had. Now, back before 1994, as long as you wanted to work but you weren't looking because you were convinced there were no jobs to be had, you were counted as a discouraged worker. After 1994, they only counted you as a discouraged worker if you had been discouraged for less than a year. The difference is that where the headline unemployment, before coming into the screwy things, pardon the language, that we've seen in the last couple of months, go back to February, headline unemployment was at 3.5%. Now that's what they call the U3 rate. That's a headline unemployment. Have to be actively looking for work. They have what they call the U6 unemployment rate, which includes short-term discouraged workers. They're people who've given up looking for work because there are no jobs to be had, but they've only been discouraged for less than a year. They also have an adjustment there for those who would like a full-time job but are working part-time because you could only get a part-time job. That's the U6 rate. So that where the headline rate was 3.5%, the U6 rate back in February was 7%. On top of that, I estimate what was lost in the changes of the long-term discouraged workers. The effectively long-term displaced workers, people want a job, but there's no job for them where they are. Back then, my estimate was 21.1%. That's how much that definitional change affected the headline unemployment, or the broader unemployment measures by. Now, the real funny things happened as we got into the pandemic reporting. Aside from all sorts of surveying qualities, the initial reporting here went from 3.5% in February to 4.4% in March. But then if you read the report, and they're generally very forthright about what's going on, or if they're having trouble with the numbers, they indicated that there were 1.5 million people who were unemployed, but they've been counted as employed because people who did the surveying made mistakes as to where they classified them. But once they have the survey done, they never change it. They won't make corrections to it, supposedly. So had those people been counted as unemployed, instead of being at 4.4%, that would have been 5.3%. Then you get into April, and the problem gets worse. They say, oh my goodness, we had 7.5 million people who were unemployed who we counted as employed this month. We don't know why this is happening. We've got to figure it out, but we can't change the survey. So that's the month that the headline number jumped up to 14.7%. But had they counted the people they knew that were really unemployed, that would have been up to 19.5%.
So, John, I wanted to stop you right there, just to do a compare and contrast, if you don't mind, before the coronavirus pandemic and after. You're saying that your unemployment rate was around 21%. I think you said 21.1, which is not that far off from Great Depression highs. Are you saying that we had that much unemployment before coronavirus?
Oh, no. I mean, we did in terms of my number, but
Okay.
you didn't get to the Great Recession highs until April with the coronavirus, with that headline U3 unemployment rate. Now, with that number there, the U6 was up to 27.5%, and that surged relative to the U3 because there were a lot of people who had been full-time, laid off, put on furlough or whatever, and they took a part-time job because that's the only thing they could find. So you had some increase in the U6 tied to the part-time. My numbers build on top of the U6, so that at the relative peak in April, my number got up to 39.3%.
Wow. That's an astounding number. How long can the economy go at those numbers? Because I know there's a lot of controversy right now over
the economy has collapsed effectively.
Wow.
What we're going to see, I mean, everyone's hoping we're going to get a rebound in the third quarter. The Fed's already said, oh, the second quarter is going to be the worst number ever seen. Yeah, it is, and there's some disagreement as to how bad it's going to be, but it's agreed that it's going to be really bad. For example, right now the consensus outlook seems to be around an annualized quarter-to-quarter, this is adjusted for inflation, contraction of about 35%. We've never seen anything like that. My estimate is it's going to be about 50%.
Oh my God, that's amazing. So okay, now it all makes sense what you're talking about at the beginning of the call. We're talking about collapsing and the Fed printing money. In reality, when you look at reality, the economy is not doing well at all. In fact, it may be in its worst shape in a long, maybe since the Great Depression. Do you think?
Oh, it is. It's by definition it would be, but it's. I have problems even calling it a recession. It's an economic collapse triggered by an external event being a pandemic. This is not driven by normal economic factors where, for example, although the economy was slowing down coming into the pandemic, which nobody wants to talk about, the Fed had raised interest rates, had tightened up liquidity in advance of this, and consumers were suffering. And the results you were seeing, for example, before the pandemic, the fourth quarter retail sales, adjusted for CPI inflation, adjusted for inflation, contracted. This is the holiday shopping season quarter, fourth quarter of 2019. That contracted quarter to quarter. It contracted in the first quarter as well. In fact, I think that was actually the second quarterly contraction. The third quarterly contraction was the first quarter, which had some initial impact from the coronavirus. You have 3 months in the quarter. March was hit hard by the coronavirus. So the first quarter GDP was down at an annualized pace of 5%, which is the worst quarterly decline since the Great Recession. 35% decline, be the worst ever seen. 50%. What 50% would do, and I can tell you that we already have some numbers that are showing that order of magnitude. We now have the July employment numbers in hand, unemployment, and if you look at the household survey, which is the one where they calculate the unemployment rate, they count a person as employed or unemployed. And if you look at that, look at those numbers and make the corrections that the BLS says, yeah, we missed in June they only missed 1.9 million unemployed and counted them as employed. They're improving there. But if you add them back in and look at the first quarter versus the second quarter, just in terms of the number of people, average number of people employed, the first quarter versus the second quarter, and employment's a very good measure of economic activity. Second quarter employed count was down by 49% annualized from the first quarter. That's consistent with a 50% decline in the GDP. And if the GDP declines that much, what it will do is it'll wipe out all the economic growth that we've seen since the Great Recession. All the economic recovery since 2009 would just disappear. But that's not due to the economy per se being hit by the Fed's tightening before that was slowing down consumer purchases and such. It's due to the economy being shut down by the government. In like manner, when it gets reopened, if it was just a matter of saying, okay, everybody can go back to work, you could have a very fast recovery. They'd spend more money to try and balance things out for people, as they've done with support packages and are likely going to continue to do. They'd still have some inflation problems, but that would be containable. But you don't have, we're not going to have an economy that just can open up again. They're trying it, but they're already having some problems. And I'm seeing some issues where things are not opening as planned, or people are having to shut down again. And that becomes an issue, because the only way you can get the economy back to where it was before is to have it fully open. A lot of businesses have already failed. That's going to be difficult. People go back to work and where they were, and it's going to take a while to get everything back to normal. This is not going to be a V-shaped recovery as some have been hoping for.
Yeah, it's not, if you look at the stock market, there's a little bit of a V-shaped recovery, but a lot of that has to do with money coming in that's available to companies, but it's certainly not based upon sales or earnings.
No, you have people on Wall Street and the Fed, and very, very particularly, doing all sorts of things to prop up the stock market. And the administration is too. I mean, they have ever since the great crash back in '87, they put into play the what's popularly called the plunge protection teams, the President's Working Group on the Markets, was initially headed by Alan Greenspan. And the plunge protection team was called in back in December when it crashed in December 2019. Mm-hmm. And it certainly was going full force with the coronavirus crash here, and it's still being manipulated. This is not a real market. I wouldn't put a penny in the stock market right now myself.
Yeah. Wow, that's I kind of agree with you there. I'm a gold guy, so I've been out of the general stock market for quite a few years, but I agree with you in times like this. It does not make sense to put money in the stock market, because at some point valuations have to go down if you're not earning money and the economy is shut down. I have a question for you on the banks. I know the Fed is pumping money into the system. How long does this have to go on before the economic crisis turns into a banking crisis?
Sorry, could you say that again?
Yeah, how long does this have to go on before it goes from an economic crisis to a banking crisis?
Well, the Fed has indicated that it will create whatever money it has to create to keep the system afloat. It's going to fund the banks, whatever it has to do to fund the banks to keep the banks afloat. I don't think the banks per se are going to collapse, because the Fed's just going to keep putting money in them. What's going to happen is you're going to have a hyperinflationary collapse, because as all the money gets pumped into the system, you're going to see a pickup in inflation and effectively a hyperinflation. And when you have that, when you've got hyperinflation, you've got all sorts of wonderful numbers that start picking up until people start subtracting the inflation out of it. I mean, if you've got inflation up at start at say, let's say we get to the end of the year and inflation's at 20%, you'd probably see. Well, let me put it this way: if you're reporting your earnings could be up 20%, but they're zero. They've gained zero if you do it against inflation. So inflation-driven growth. It's not adjusted for inflation. The nominal growth, I mean, it could be extraordinary, but it's all in inflation. It's not in real economic activity or real constant dollar profits.
Mm-hmm.
So again,
you said earlier that gold is predicting inflation. It runs ahead of inflation. What is a predictor for hyperinflation? Is there any predictor?
Well, it's. I mean, you can look at the growth in the money supply. If you start seeing that accelerating, and it has generally been accelerating since it started. Right now, we're seeing year-to-year change in. You have M1, M2, and they used to have M3. I still track M3. But right now you're approaching 40% year-to-year growth in M1. That's the smallest, but the narrowest definition. That's cash and near cash instruments. That's unprecedented. I mean, never seen anything like that. At least since they've been tracking money supply. I mean, you maybe got up to 6% at one time or such. We're already beyond anything that's ever been seen in the United States. Mm-hmm. That keeps growing. If you go beyond 100%, you're effectively into a hyperinflation. We're getting close to it. You're not seeing it at the CPI level yet, but even there, even with all the gimmicks they play with the inflation, you'll start to see it. I mean, like beef prices being up 48% in a month. It's a very difficult time.
Yeah, I think that's a reason why people want to follow your website. And again, I've been following it for years. And John, I really appreciate what you put out, because I would not have understood the real numbers on the economy until I came to your site and started seeing that type of data. And that's what caused me to go and look at this. And I think what people need to understand who are listening to this conversation is, if they go to your website, they're going to get some advanced warning of what the real inflation rate is. I know you mentioned 20% by the end of the year. That's phenomenal. I don't think we even reach 20% in the 80s when we had that high inflation.
Well, right. I mean, right now it's turning about 9% in terms of the inflation.
Yeah.
The way it would have been calculated before, but with the money supply growing right now, your cash is going in the system at 40%. M2 and M3 down the 25 to 30% range, but it's still well beyond anything ever seen before in U.S. history.
Yeah. Wow, that's astounding. It's something I wrote about 10 years ago, but actually seeing this take place is just, it's different when you see it in person. I mean, what's your reaction to this, John? I know you've been covering this for so long. What's your reaction now that it seems like we're here, all the things that we've been warning about for so long?
Yeah, it's frightening.
Yeah.
I mean, let me put it this way. I always thought that the way the Fed was operating and the way the federal government was operating without any concern as to its long-term ability to pay off its debts or to have a contained budget deficit would lead us to an ultimate hyperinflation. And I thought we might have something like that back in 2014. When you had the, 20, I was looking at in 2014, but it was an outcrop of the Great Recession and the panic came with the collapse of the banking system and all that was done to support the banking system.
Mm-hmm.
They did nothing in terms of the scope of what's being seen now with the collapse of the banking system and what they did to prop it up.
Yeah.
And right now it's just uncontained. That's the difference. It was contained. They did try and control things then. They're not even trying to control it at the moment. So,
I guess final question for you, John. I know we've been talking about this for a while. I want to let you get back. If we turn around and get some sort of quick recovery, I know it's not going to be ideal. Not everybody's going to go back to work. There's a lot of structural damage done. But if sometime in 2020, people get back to work and we start growing the economy again, are we going to stave off the hyperinflation, or do you think that's written in the cards no matter what happens for the rest of the year?
well, it'll be difficult to see how it's all avoided, but there may be. I mean, if the economy actually starts to pick up, if they can get people to go back to work, to not have to worry about being infected, or that there's a treatment available. There's a vaccine, treatments. That's something that people can live with. When you have something as it is right now, where you do not have that, it's true that the younger people are, in theory, not as badly hit by this, but that's apparently there's some exceptions to that, and the problem is that most younger people also know older people, like grandparents or old farts like an economist that started making predictions back in the early 80s that are very vulnerable to something like this that could end their lives. So it keeps people readjust their lives to match their risks and their families, and it's just not a circumstance where it's easy to get people to go back into normal circumstance. You look at the reopenings of some of the casinos, for example. There you have a lot of people that were supposed to gather in isolated areas, but that's not always worked. People still tend to congregate, and you get crowds, and some places are now being shut down again.
Mm-hmm.
It's very difficult for the people with the small businesses, and particularly they're servicing the public, and whether it's a restaurant or something that involves direct contact with a lot of people. Those are places that are going to have a tremendous amount of difficulty getting back to normal until you have the virus under control. So I just don't see it. I wish it were all in place and that you'd be, we're going to be seeing a lot of growth in the economy, and you will be seeing growth in the economy once you hit bottom. And this is, let's say I'm right, even if you get a 35% hit on the GDP instead of a 50% hit on the GDP,
yeah,
you're likely going to hit bottom in this current quarter, the second quarter, possibly the third, depending upon how these attempts at reopening tend to go. But once you've hit bottom, everything from there is then growth. So maybe you'll have 5% growth in the economy in the next quarter. And while that's good news, you're still going to be down a very large amount from where you were the year before. And you're still going to have a ways to recover. And you're still going to have a lot of people that are suffering. It's a very difficult circumstance. But there will be a recovery. I'm sure they will bring the virus under control at some point, and hopefully a lot sooner than later. And the longer that the problem goes on, the greater the risk that you end up in this hyperinflationary Great Depression. If you had a chance that if everything were in place today to reopen the economy, people they were confident they could be treated, or that they could get or could get a vaccine. Then you'd have a circumstance with some confidence that people could reopen, and there might be a lot of money created to try and get the economy back off the ground. But if they had a plan to bring the money back under control as things reopened, which I'm sure that's what the Fed's hoping for, that would be might be able to forestall a hyperinflation. Although you're still going to have some inflation problem, but I just don't see that. I don't see that happening. It might, but I think there's a real risk here of the hyperinflation. And putting that aside, you're certainly going to see higher inflation as this continues to unfold. And then again, that is bullish for both gold and silver.
Yeah. John, this has been a great interview. Of course, I cannot recommend you enough. John Williams of Shadowstats. Thank you so much for joining us. Appreciate all of your research. For those interested, just go to shadowstats.com. John, can you give us a little bit of information about how they can sign up for your service?
Oh, sure. My website is shadowstats.com. You go there. There's a lot of material there that's open to the public. Left-hand column of my homepage are the most recent postings, but there's also an archive there, and any newsletter that's more than three months old is available to the public. You'll also see links to my alternate inflation measure, my alternate unemployment measure that at least shows you the graphs. It shows non-subscribers the graphs and gives you some background on it. The newsletter itself is available by subscription, $175 a year, $89 for 6 months. Always happy to talk with people and pick up new clients. But you can find a lot of, my right-hand column of my homepage has available to everyone quick updates of all the latest numbers, including unusual twists to them. And that's the stuff that gets written about in the commentary. So you can, and anyone visiting it can get a pretty good sense of what I'm looking at.
Great. Thank you so much, John. We definitely appreciate this.
Thank you, and I appreciate very much your having me, Bob.
Absolutely.